This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 3 videos on trading climactic reversals, which are failed breakouts. Whenever a trader sees a breakout that looks pretty weak, it usually means that the trend is going to convert into a trading range fairly soon. Any breakout can succeed and lead to a swing trade, a measured move. Breakout can become a measuring gap. Or it can fail and lead to either an end of the trend or a reversal and become an exhaustion gap. I want to talk a little bit also about weak and strong bulls and bears. This is a 5-minute chart of the euro versus the Canadian dollar. I always pay attention in a bear trend to see if bulls can make money with limit orders. And if bulls can make money buying at the prior low and scaling in lower, then it tells me that the bears are not as strong as they could be, and the market might soon be transitioning into a trading range. We have a bear breakout, a bear flag, a second very strong bear breakout, and now we're starting getting some doji bars. Bears are starting to take profits and they're no longer selling aggressively. We're getting some two-sided trading. A doji is a 1-bar trading range, and when you get a series of them like this, the market's probably in the early stages of a trading range. I want to see if bulls can make money buying at the prior low. Bulls, if they place a limit order to buy at that low, they'll get filled here. And a lot of these bulls are willing to buy more. 10 pips down, 20 pips down, maybe use a wide stop, 50 pips, and then look to scalp. Here, let's say a bull bought at this low with a limit order. He got filled here, and he placed a limit order to exit with a 10-pip profit. He did make his profit, and that is another sign that the market might be transitioning into a trading range. If the bulls can make money in a bear trend, the bear trend might soon be converting into a trading range. Again, a 5-minute chart, the euro versus the Canadian dollar. We have an early trading range in the European session, and that often leads to a lot of trading range price action for the remainder of the day or the remainder of the session. The height of this range is only about 20 pips. That's less than half the size of a typical session. And we have a failed breakout above the top. So we have to be thinking that if it's a trading range, a breakout below the bottom might fail as well, and the trading range might continue. And this might be warning us that the entire session may be a trading range day. We have a bull channel, and we have a bear breakout below the channel, but there's something wrong with this reversal down. Can you see what it is? We have a big bear bar and then a couple dojis. We have a good bear bar and then a bull bar. We have a big bear bar and then 3 dojis. We have a big bear bar and then a doji. Where are the consecutive big bear trend bars? Why are there prominent tails? Why are bars overlapping each other? This is bad follow through after every good bear trend bar, and that increases the chances that this sell-off is a bear leg in what will become a trading range rather than the start of a bear trend. If it's going to be a trading range, we could get a pullback from this bear breakout. It's a bear breakout below a bull channel. And if it's a trading range, that pullback could be very high. It could retrace much of the bear leg down. And you can see we got a strong reversal up, but because the trading range is likely, a pullback from here could retrace a lot of that bull leg as well. You can see we went to a new high and another new high, but then we went down to a new low as well. Trading range price action, lots of reversals. Strong breakout, but a very deep pullback. Deep sell-off, but strong reversal up, retracing much of the bear leg. So lots of big up, big down, big up, big down, big up, big down, big up. That generates confusion, and it makes traders believe the market's not going to go very far. That leads traders to take quick profits. Also, it makes them hesitant to buy high. If they buy high and see a deep pullback like this, they'd rather buy the pullback. So traders tend to want to buy low, and they want to sell high, sell at prior highs, betting that the breakouts will fail. They're buying low, selling high, and taking quick profits, and the result is a trading range. You can see the videos on trading within trading ranges for stop placement and how to trade within a trading range. This is a trading range, lots of reversals. When you're buying low, you can be buying to get long, but you can also be a bear buying to take profits. And in a trading range, when you're selling high, you can be selling out of longs to take profits, or you can be selling to get short, like selling at the high of a prior bar, betting that you'll make money on a scalp down. You have some bears who look at this bull trend bear flag. We're getting a bear breakout. We have a bear bar and follow through. Some of the bears will sell closes, betting that this will be the start of a bear trend that will go a long way. However, when they see the reversal up from a prior low, it's also an expanding triangle. We went up, and then a lower low. We went up higher, and then a lower low as well. Expanding triangle. Also, bad follow through on the way down. The bears did not get good follow through after this close. Most bears would exit above this bull bar. They suspect at this point that instead of a sustained bear trend and a lot lower prices, and instead of a measured move down, maybe based upon the height of this range, this is probably going to be a trading range. So if they sell these closes or sell this close, they're going to get out right here. Three or four pushes down, 1, 2, 3, 4. Also an expanding triangle. You can call this a parabolic wedge. It's a very tight channel with 3 pushes down. That tends to reverse. It tends to be a climax. It tends to get a deep pullback. And an expanding triangle, up and down, tends to get a reversal as well. And then we have a micro double bottom. We went down here. On this bar, we went up and then down into the close. And then we're going up again with a bull inside bar. It's actually a reasonable buy signal. Bulls will buy above this bar to get long, and bears, if they sold, will exit. Trading range bulls who expect that this is a bear leg in a trading range and a failed breakout below the low of the day, they'll buy the reversal up, expecting the market to test at least to the middle of the range, maybe to the top of the range. And the bears buy back their shorts, looking to sell again near the top of the range. The trading range bulls, they'll exit maybe below this bar, it's a micro double top, or they might exit above this bear bar, betting that it's a bad buy. The trading range bears, the bears who believe it's a trading range, see the micro double top up and down and then up again, and they'll sell below that bar as well. Also, it's an expanding triangle. We had an expanding triangle bottom, and we have an expanding triangle top. Even though this high did not go above that high, it's virtually an expanding triangle. And it's nested. There's a small one here as well. Up, down, more down, and then more up again. A lot of patterns are not perfect. This high is not above that high. At least it does not look like it's above that high. But it's close enough, and it will function like an expanding triangle. In trading range, pretty much every buy at the bottom is an opportunity for bears to buy back their shorts and the bulls to get long. Every sell at the top is an opportunity for bulls to sell out of their longs and for bears to sell short. And theoretically, you could reverse all day. But the reality is most experienced traders don't like to reverse. So they'll be doing one or the other. For example, getting out of longs or getting into shorts up here and down here, getting into longs. Or if they're short, they'll be getting out of shorts. A lot of the bears who sold here will scalp out with 10 pips and then they'll buy here. A lot of the bulls who bought here will scalp out with 10 pips and then go short up here. It's difficult to be objective about taking an opposite trade when you're in a trade. It's usually better to exit first and then wait a bar or two before considering taking a trade in the opposite direction. And therefore, even though theoretically it's easy on paper to reverse, most experienced traders do not reverse. They'll do it sometimes, but not all day long like this. If you're one of the rare people who can do it profitably and comfortably, then you can do it. But chances are you're not. Chances are it's better just to buy low, scalp out, and then wait for a sell signal, and then sell high, scalp out, and wait for another buy signal. A breakout can succeed or fail. Most breakouts, in fact, fail. 5-minute chart of the euro versus the US dollar. Every trend bar is a breakout, even a small one like this, and every trend bar is a climax. So this is a buy climax, here's a sell climax. But most of these breakouts fail. Most breakouts do fail. A climax is an extreme acceleration of a move up or down, so this is a sell climax, and this reversal is a buy climax. If the context is good and the breakout is strong enough, it has a higher probability of leading to a swing trade. And if it's not, it probably will just reverse because most breakouts fail. Here we have a strong bear breakout, it failed. We have a bull breakout, it failed. Remember, every trend bar is also a breakout bar, and it's also a climax. I don't use the term climax for every trend bar. I usually call a bar a trend bar, but if the context is right, I will refer to it as a climax if I think it might be the end of a move, an exhaustion move. If I think it's the start of a move, I'll talk about it as a breakout. So for example, here's a breakout late in a bear trend. It's probably a climax. So I would call it a breakout, but I'd say it's probably going to be a climax and the trend will probably end. Here is a reversal, a breakout to the upside. After a big bear trend, I would call this a breakout. It has a decent chance of leading to a swing up. These are all buy climaxes. They're all bull breakouts, the green ones. And the red ones are all bear breakouts, and they're all sell climaxes. Most breakouts are minor, and they do not lead to trends, and they do not lead to reversals. If anything, if they lead to a reversal, they'll lead to a minor reversal. If they lead to a trend, they usually lead to a minor trend, and then a reversal. You can see the videos on trading in trading ranges and trading in broad channels for more about breakouts and climaxes. 5-minute chart, the euro versus the dollar. The market is working higher. And then we have a surprise bar, a very big bar, closing on its low with a very big bear body, closing far below the low of the past 20 bars. Is this going to be the start of a bear trend? Or is it going to be a bear trap? Is it going to be a failed bear breakout? In other words, will it result in a measured move down, maybe from the open of this bar to the close of that bar to a measured move down? Or will the gap between this close and any of these lows close? Will it be an exhaustive move? Will that gap be an exhaustion gap? Whenever there's a big breakout, especially late in a trend that has gone on 20 or more bars, traders pay a lot of attention. They're looking for evidence of whether or not it'll be the start of an even stronger trend or an exhaustive end of the trend leading to a trading range or even a reversal. Big bear bar, closing on its low, closing below the low of the past 20 bars. There are different ways to draw gaps from this close to that low, this close to that low, this close to the low of the bar before it. Those are all gaps. And if it gets above all of those lows, then I would say this is an exhaustion gap. All of those gaps are exhaustion gaps. On the other hand, if it does not close all of those lows and we start to trend down, it's probably going to lead to some kind of a measured move down, and then I'll call these gaps measuring gaps. Here we reverse up. This high closed the gap between this low and that close. It closed all of the gaps, even the highest gap. It went above the high of the bar before the big bear bar. And therefore, this is a climactic reversal. This is a sell climax. And instead of being a breakout and the start of a bear trend, it reversed up and the bear trend ended. We tried to get down again, but all of these gaps were exhaustion gaps. And I call this bar an exhaustion gap bar. Even though it's a bear trend bar, I refer to it as an exhaustion gap. The market's been rallying for about 10 bars, 20 bars, and we're getting a bull breakout and it's accelerating upward. Is this the start of a strong trend up, or is it going to be an exhaustive end of the rally that began here or here? Right now we have a gap. We had a gap between this close and that high, this close and this high. Now we have a gap between this close and that high, this close and any of these highs. Those are all gaps. The market tried to reverse, but could not. We got a high 1 bull flag, a high 2 bull flag, a breakout of the high 2 bull flag, a pullback from that breakout, and then another big bull trend bar. Therefore, the gaps, like, for example, this low and that high, probably led to a measured move up. To me, I would refer to this as a measuring gap. And once we started to reverse up from here, I would view this as a test of a breakout point. This is a logical breakout point, and therefore I would view the space between this high and that low as possibly a measuring gap, and I would look for a measured move up from this low to that high, and we went obviously well beyond that. Whenever there's a strong breakout like that, I'm looking for measured moves, and one is based upon the gap itself and the prior low. Another is simply from the open of the first bar of the strong breakout, which is the open of that bar, to the close of the final bar. That often leads to a measured move as well. Here we have a very big bull trend bar, and what do you notice about it? Well, the bull trend began here, or with this higher low major trend reversal, and this is 30 bars ago, this is about 50 bars ago, and what do you notice about this bar? It's closing on its high, it has a big bull body, has very small tails, and it's the best looking bull trend bar in the entire bull trend. It's even bigger than this bull trend bar. So here we're getting the strongest bull breakout, 20 or more bars into a bull trend. Do you think it's more likely the start of an even stronger leg up, or do you think it's more likely an exhaustive end of the trend? Well, whenever you get the strongest bull bar, 20 or more bars into a bull trend, it's more likely an exhaustive end of the trend, and the market usually goes sideways. Sometimes it'll reverse, but usually the bull trend ends and it goes sideways for a period of time. It's a bull breakout above a bull channel. When you get a bull breakout above a bull channel, there's a 70 to 75% chance you're going to get a reversal down to the bottom of the channel within about 5 bars. Here we started to reverse after 2 bars. Because of that, if a trader is long, for any reason, he should get out of his longs and then wait to see if there's a buy setup later on. Usually after a buy climax, the market will have at least a couple legs down, and the correction will last at least 10 bars, and it usually tries to get down to the bottom of the buy climax down here. And a lot of bulls will not buy again until it has at least 2 legs down, maybe 1 pullback 2, or maybe 1 pullback 2. They want the correction down to last 10 bars or more, and they want it to test the bottom of the buy climax. And that collection of facts came in around here. But this is the end of the session. This is Pacific time. And you can see a lot of dojis, small bars, tight trading range. Bulls are not going to be buying again. This is a reasonable sell signal. You have a buy climax, an exhaustive buy climax, a break above a bull channel, a break above the high of the session, and a decent bear bar. It's reasonable to take that short. We're getting late in the session, and we may not fall all that far, but the target, the initial target at least, is the bottom of the buy climax bar down here. Some traders don't like to take the first signal. They want some evidence that the bulls are not interested in buying again, and they'll wait for 2 or 3 consecutive bear bars. We have 1, 2, 3, 4 bear bars here. We have a third consecutive bear bar here, so they'll sell closes. Here we have 3 consecutive bear bars, so they'll sell a close here, looking for at least a scalp down to the bottom of the buy climax. You don't want to be selling too close to the target. The target is here. And if you're looking for a move down to that low, you want to make sure that your entry is at least the size of a scalp above the target. So you want to make sure that if you're selling here or here, you're selling at least 10 pips above the bottom of that buy climax bar, because there probably will be buyers down there. The bulls are trying to reverse up. They're getting a lower high. They have a bear bar. It looks like a breakout test of the lows of this bar, and it's reasonable to take the short. You can view it as a double top, lower high. This high is a double top with this high. Even though it looks minor, it's still a double top. Also, we still have room to the target, and this is a very tight channel, so it's probably the first of 2 legs down. Experienced traders, in fact, will sell that close, betting that it's a gift and that the bulls will use it to take profits, and it's probably an exhaustive end of the move. So experienced traders will just sell the close and put a stop, maybe a measured move up based upon the height of that bar. Put a stop up here, sell this close. If it goes higher, sell more, betting that this is more likely an exhaustive buy climax than a measuring gap. So it's more likely to get down here than it is to go up for a measured move. This is a 5-minute chart of the euro versus the Japanese yen. And again, same kind of thing. We have the best looking bear bar, the best pair of bear bars occurring 20 or more bars into the trend. We have a very strong bear breakout here about 20 bars ago. Whenever you have the best looking bear bar or pair of bear bars or series of bear bars occurring late in a trend, it's more likely an exhaustive end of the trend than the start of an accelerated bear trend. 60% chance these 2 bars will be exhaustion bars, 40% chance they're the start of an even stronger leg down. If you see that, it's really a good time to exit shorts. You can exit on the reversal up above a bull bar, but it's also okay to exit on the close of that second bear bar. And experienced bulls, in fact, will buy that close, betting that it's more likely that we'll get up here than it is that we'll fall for a measured move based upon the height of those 2 bear bars. You can buy the reversal up on a stop, especially with the bull bar here. We have another bull bar closing in its high, reasonable to buy above its high, second entry buy, first above here, and then second above these dojis or above that bull bar. Looking for, at a minimum, a test of this high or the test of this high, and at least 2 legs up and 10 bars up. Now we're getting a pretty good reversal, a bull breakout and follow through. You can also buy here, but you need to stop down here, expecting the market to go for a measured move up. We have a gap between this close or this close and these highs, and the low of this bar and these highs. This is probably going to lead to at least a measured move up. And we have an obvious target, the top of this bear leg. Market's probably going up there. If you're taking a buy this far above the low, you have to make sure that your target is at least 10 pips above. This is not 10 pips above this entry price. So if you take this entry price, you got to be really quick to get out if it starts to reverse down. You have a target that's not 10 pips above. There'll be profit taking. The bulls will take profits around here. If it starts to reverse down as it did here, you get out. If it goes up, fine, you can take profits at 10 pips, or you can hold for a swing. this is probably not going to be a major reversal. When the bear trend is this tight, usually the reversal up is minor. But once you see a strong minor reversal, then the next reversal attempt has a better chance of being major. This late in the session, again, this is California time, there's not enough time for a day trade swing up. Higher or low, major trend reversal. We have a bear trend, very strong bull breakout lasting about 30 bars. We have two legs down to a higher low. It is a higher low major trend reversal, but if you're a day trader, this is too late in the day. You can see the bars are starting to get very tiny. Nobody's trading, so not a particularly good buy. Extremely strong sell climax. Experienced traders will bet that it's an exhaustive end of the move instead of the beginning of an accelerated sell-off, and therefore they'll buy that close and look for a test of this high, the top of the sell climax, or the top of this bear leg. The traders who buy this close are going to use a stop that is a little bit more than a measured move down, maybe from the high of this bar to the low of this bar. So they'll put a stop down here. And a lot of them will buy more if there's one more brief leg down. The bulls who buy higher are buying higher because they want more probability. Whenever you are trying to get higher probability, you pay for it with worse risk reward. That's always a trade-off. Anytime you take a trade where the probability is higher, you're going to have worse risk reward. That means your stop is further away and there's less profit remaining in the trend. However, both types of entries are reasonable, and it's a matter of personality. Some traders like really high probability trades, and they're willing to accept more risk. Other traders want maximum profit, and they're willing to accept lower probability. I'm going to talk a little bit about what the weak bulls and bears are doing and what the strong bears and bulls are doing during strong breakouts. 5-minute chart of the euro versus the dollar. And we have a very strong bull breakout. Now, weak bulls, they've been looking at this rally saying, it's going up, but it doesn't look all that strong. And then they see this and they say, wow, now it's really strong. I'm going to be buying up here as it's going up. They see this very strong breakout, and now they're convinced that the market is very strong. They mistakenly believe that this is the start of a big bull trend, instead of looking to the left and saying, we're at the top of what might be a trading range, and this is a strong move 20 bars into the trend, 30, 40 bars into the trend. It's more likely an exhaustive end of the trend than the start of an even stronger trend. There are not enough beginners, not enough weak bulls to buy up here to keep the trend going. The weak bears, they see the rally as weak. The bull body is getting smaller, dojis, bull breakout small bar, doji, bull breakout tail, and bear bars. So they're selling all the way up. They're selling above bars, they're selling below bars. They're betting that this is going to be a trading range, and this is just a bull leg in a trading range. But at some point, when it starts to accelerate up, they just give up. They've been selling all day, and they just give up. So the weak bears are buying back their shorts in a panic. They can no longer take the pain, and they just buy back their shorts. You have weak bears buying back shorts. You have weak bulls finally deciding that the market is going higher, and they're buying. Both the bulls and the bears realize that this might be a climactic end of the move. But the bears are afraid of the risk, so they can't take it anymore. They have to get out. And the bulls missed the whole rally, and they're hoping that even though it's a low probability of a big bull trend, they're hoping that they catch that big bull trend. So both are willing to buy, even though they know the probability is low. The bears who sold for any reason, if they're still short, their loss is too big and they can't risk losing anymore, and they have to buy back their shorts for a big loss. Even though they know it's more likely that this is going to be an exhaustion gap than a measuring gap. Once the weak bears finally give up and buy back their shorts, and the weak bulls finally buy, who else is going to buy at this price? Nobody, because that's not what the strong bulls or strong bears are going to do. They're not buying up here. The strong bulls took the difficult trade and they bought earlier, down here maybe somewhere in here, and they used an appropriate stop either here or even lower, and they would have added on lower. The weak bulls don't want to buy down here. They're looking for a perfect trade. They want high probability and small risk. Here, they think they have a perfect trade, or almost a perfect trade. All they see is probability. It's probably going up, and they're ignoring the risk. But down here, they think the rally is too weak to buy, and therefore the probability of making money is too small, and they don't want to risk that much. So they don't want to be buying here and risking that much. In hindsight, they want to buy above this bar and risk here, but by the time they decide it's going up, it's too late and the risk is too great. So the weak bulls are not buying here. This is where the strong bulls are buying. What are the strong bears doing down here? They see this as possibly a reversal, a double bottom or a higher low major trend reversal, and they don't want to be selling low, especially after a sell-off that looks as weak as this. They only want to be selling high. So they're not going to sell. They're going to wait until it gets high. The strong bulls who bought down here, what are they thinking up here? They're thinking, yes, the weak bears are finally giving up, the weak bulls are finally buying, and the strong bears are probably going to sell. Once the strong bulls see the best looking bull bar occurring late in the bull trend, especially a breakout above the top of a potential trading range, they're going to sell. They're going to sell to take profits. They were waiting for some sign that the weak bears would finally give up, and they got it. They have the strongest buy climax late in a bull trend. Great opportunity to take profits, especially when the rally is not all that strong. And it might be a failed breakout above the top of a trading range. We've had a lot of trading range price action. We went up, we went down strongly, we went up strongly, we went down, we're going up. We're probably going to go down soon. And the bulls view this as a surprisingly great opportunity to take profits at a very high price, and they don't think it's going to last. They think the breakout will fail. And therefore, selling here is a brief opportunity to sell at the high of the day. If you're a strong bull and you bought down here and you're taking profits up here, are you going to buy again 1 or 2 bars later, or 5 or 10 pips lower, 20 pips lower? No, if you were holding through all of this, you're not looking to buy again just a few bars later and 10 or 20 pips lower. You're going to wait and give the bears an opportunity to see if the bears can create a reversal out of this buy climax. You'll probably wait for the market to get down here and see how strong the sell-off is. If it has low momentum and there's time left in the day, you'll buy. Here, the sell-off had no momentum at all, good for the bulls. However, we're at the end of the session, bad for the bulls. So we're starting to get a lot of small sideways bars, and the bulls never bought back again. If you sat through 20 or 30 bars and you take profits, you're not going to be buying again 1 or 2 bars later. If you were thinking that you might buy again 1 or 2 bars later, you would not exit. You'd hold long. The strong bulls are taking profits because they think it's a great price to take profits. They do not think it's a great price to be long or to buy. They know the market has to go lower to find some price where the bulls will be willing to buy again. By the time it got to a price where they might want to buy again, the session was over. What are the strong bears thinking? They know the bulls will see this as a tremendous gift and the bulls will take profits. They know that the strong bulls will not want to buy again for at least 5 or 10 bars and a test of the bottom of the buy climax. And guess what? The bears are then going to sell. they're selling exactly at the same time that the strong bulls are selling to take profits. At the end of the session, the market reached the first target, the bottom of the buy climax, and they'll take profits here. And this little bounce here is mostly due to the bears taking profits around that low. Why is it not due to bulls buying? Because it's the end of the session. Bulls do not have enough time to make a profit, especially when the bars are starting to look like this. Now, what about these bears who sold up here? Now, let's say it's starting to go up higher. Those strong bears are not going to buy back their shorts. That's why you call them strong. They're confident that the market is climactic and it's going to reverse down. They'll sell here, they'll sell more here, they'll sell more here. They're betting that no matter how strong this is, the odds are it's going to be a climactic end of this bull trend and reverse down. And therefore, the only bears willing to buy are the weak bears. The strong bears are not going to buy. So there's no more short covering, or maybe one more push up to get rid of the remaining weak bears, but the strong bears are not going to give up. So you're not going to be able to force them out. Strong bulls, they know the market's getting expensive, and they're not going to try to make the strong bears give up. They know the strong bears are not going to give up. And the bulls also know this is a great price. It's a surprise gift, allowing them to exit with a great profit. And therefore, instead of the strong bulls buying, trying to flush out the remaining bears, they're selling to take profits because they know they cannot buy high enough to make the bears give up. They know the bears will sell as it goes up, and they also know that their partners, the other bulls from the other firms, will view the market as way overdone, and they'll be selling. So there will not be enough strong bulls to overwhelm the strong bears. Not enough bulls wanting to buy up here, and too many strong bears wanting to sell, and therefore the market has to go down. If you're a strong bull taking profits up here, as I said, you're not going to be buying again 2 or 3 or 4 bars later. You know the odds are the market's going to test the buy climax low. So you're going to wait for 2 legs down, 1 pullback 2. You're going to wait for usually at least 10 bars down, and you're going to wait for a test of this low. And until you get all 3 of those things, you're not going to buy. And when all 3 finally occurred, the session was over, and the bulls did not buy. Strong momentum, but the bulls do not believe it's the start of an even stronger leg up. They view it as the final weak bears buying back shorts and weak bulls buying, and that's not enough buying to lift the market. These bulls bought down here when it was cheap. It's now expensive, and they know this will attract strong bears, and it will attract other strong bulls into exiting their longs. The bulls want to buy value. They don't want to buy when it's expensive. The market's overbought, and it's probably going lower. So the strong bulls are not going to be buying up here. When the bulls sell to take profits, one of the reasons they wait for a couple legs and 10 bars is they want to give the bears an opportunity to reverse the market. They want to know if this buy climax is going to lead to a trading range or to a bear trend. If it's going to lead to a bear trend, they don't want to be buying until late in the bear trend. If it's going to lead to simply a trading range, then they're willing to buy. Here, the sell-off is weak, but it's the end of the day and too late for the bulls to buy. I talked about weak breakouts and how they usually are a sign that the market's going to evolve into a trading range. And I also talked about how breakouts can succeed or fail. If they succeed, they usually lead to a measured move, like a measuring gap. And if they fail, the breakout bar, I call it an exhaustion gap. The market usually tests the opposite end of the bar. And I also talked about how weak and strong bulls and bears behave whenever there's a big climax bar, a big trend bar late in a trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 3 videos on trading climactic reversals. A climactic reversal is a failed breakout.